Hello again, fellow BeachBum traders. Today I want to share with you very briefly how selling covered calls against a position that you hold, particularly in a retirement account, can sometimes be a double-edged sword. And for this particular video, I'm going to use an example with a position that we took in SOX, SOXS, which is the short on semiconductors. And we took this position. We went long on SOX back in November of 2021 and at 54.10. So you can see we have a long position at 54.10. And if I look at SOX and FinViz, we can see we took this position back in November. We kind of went at bottom there. And our thesis at that time was due to the supply chain issues and the pandemic that the shortage in semiconductors would eventually roll over. Semiconductors are, like any commodity, tend to be very cyclical, and we'll look at the cycles in the near future. So we expected at some point that there would be, again, an oversupply, demand would wane, supply would increase, and semiconductors would roll over, and therefore SOX would eventually go up. So we took this long position in SOX, and we knew, over some period of time, semiconductors would eventually roll over, and this position would be profitable. And in the meantime, while we were waiting for that to happen, we had the option to sell covered calls against this position in SOX and generate some additional revenue while we waited for that rollover to occur. So back in March, we sold a covered call against this position for a $60, what became a $60 strike price. And got a nice profit. You can see another thing I'll talk about is when is the best time to sell covered calls. So we sold that, and as you can see, $60 is essentially a pivot point, which is then a resistance point for SOX. So the probability would be, as you can see in the past, it just briefly breached that and then bounced back down. So we thought, okay, that's a pretty safe point. So we sold the covered call against SOX at 60, collected the premium, and then we're just waiting. And that was a May covered call, so it was a May 22 covered call. So now we're sitting in the middle of April, and you can see SOX is now running up. So now we're in this position where it's kind of a double-edged sword. Is because we're in a retirement account, we can't put a stop limit or any kind of stop loss on our position, even though it's currently profitable, because we have that outstanding covered call. So that's where the double-edged sword comes in, is if you've sold the covered call for a future strike price on a position in a retirement account, again, because you can't short in a retirement account, we can't put a stop to protect our profits against that position until that covered call expires. So again, that's just something to consider. Now, part of the benefit of selling that covered call is we have a guaranteed about 10% profit. If that does expire in the money in May 22nd, then we will collect $60 per share. So we'll get about a $6 profit, almost a $6 profit, plus the premium we collected on that covered call. So we'll get about a guaranteed 10% profit if it does expire in the money. However, what we're missing out on, and again, this is part of the double-edged sword, is you can see the range for SOX for the 52-week range goes as high as 120. Well, if it's above 60 as of May 22nd, or even before that, if it's an American-style option, which it is, they could exercise early, and so we could miss out on any further upside in SOX. So again, that's kind of where the double-edged sword comes in. When you sell a covered call, number one, you can't put a stop limit in to protect your profits, and number two, you miss out on any further upside. So you have to be content with the profit you're getting at the strike price that you sell the covered call, plus the premium you've already collected. and be satisfied with that profit, which is fine. Again, we would make a 10% profit at 60 plus the premium we collected, so we can be satisfied with that. So, and if it does bounce off that resistance and trails down, it would have been nice to be able to protect our profit in the meantime. But again, since semiconductors are very cyclical, we would expect it to cycle back up, and we can always sell covered calls again. So now we'll talk about when are the best times, how do you figure out the expiration dates to pick, and when are the best times to when to sell and when not to sell covered calls. So when do you want to sell covered calls against your position versus when do you potentially want to put a stop loss and protect your profits against that position? Again, this is the double-edged sword that you want to consider. And the first factor to consider is how long do you plan to hold this position? Are you planning to hold this position for a long period of time? Is this a long time investment and you would like to sell covered calls against it to generate some additional income, essentially generate your own dividends for that position, assuming it is optionable, and you're going to hold it whether it declines or is above your purchase price, again, for a long period of time, or is this more of a swing trade, scalp trade, where you want to be able to protect your profits with a stop limit or a stop loss, and you don't want to get locked in with a covered call. So that's one of the primary considerations you want to make. If you're going to hold it for a long period of time, despite whether it's above or below your purchase price, and selling covered calls to generate additional income is probably advantageous. If you're looking at it as a swing trade and you're not sure, what amount of profit you'll be able to get out of it, you want to swing it up until it peaks and turns down, then you may want to be able to protect your profits with a stop limit or a stop loss, and you don't want to get locked in to having to hold it. Again, particularly this is all specifically in a retirement account. You don't want to be locked into having to hold it and potentially have a decline on you by having an outstanding covered call. So again, those are some of the considerations you want to make when deciding whether or not to sell covered calls against your existing positions, again, particularly in retirement accounts. In cash accounts, etc., where you can essentially go short by selling the covered call and putting the stop limit in, then you might not run into such a restriction. So I hope that helps. Another factor to consider in deciding when to sell covered calls and when not to sell covered calls is your position currently profitable? Is it in the money? If your position is currently profitable or you expect it to soon be profitable, then you may not want to lock in not being able to put a stop limit or stop loss underneath your position that's already profitable by selling a covered call against it. Again, in a retirement account, you could probably only do one or the other. So again, if your position is currently profitable or you expect it to very soon be profitable, you might not want to sell a covered call against it at that time. On the other hand, if your position is currently not profitable and it's you don't know where the bottom is, but it's particularly if it's starting to turn up a little bit, that may be an opportunity to sell a covered call, generate some income while you wait for your position to again become profitable. So again, that's a major consideration is your position currently profitable or not, or do you expect it in the near term to become profitable just because a short-term irrational bounce down and you expect it to bounce back up, become profitable, and you're going to want to put a stop limit in. So in that case, you probably don't want to try to sell a covered call against that. So now let's talk about, in the case that we do want to sell a covered call, when is the best time to sell that, and then how do we decide on the expiration date and the strike price. Okay, assuming that you have decided based on your time frame considerations and the profitability of your position that you do want to go ahead and sell covered calls, then when is the best time to sell a covered call? Well, the best time to sell covered calls is when your stock is in an uptrend, when the price is increasing, and the faster the price is increasing, the more volatile the price, the more rapidly the option price is going to increase as well. So the best time to sell covered calls is, again, when your position has a profitable increase, it's on an upswing. These upswings, particularly these large bars, these major increased days are the best days on which to sell covered calls. Again, the volatility and the price increase will cause the option price to increase even more rapidly, and those are the best times to get the best price and also the highest probability that because of the implied volatility that someone will buy your covered call, because the implied volatility will increase the probability that option will be in the money in the future, again based on the implied volatility. So again, the best time to sell is when the price is increasing. You don't want to be selling covered calls when the price is decreasing. Now, part of the benefit of this strategy is you could sell the covered call and collect the premium on the increase, collect a high premium, a higher price on the increase, and then if the price does decline again, you have the option to buy that covered call back, hopefully at a cheaper price. So the best time to sell covered calls is when the price is increasing. The best time to try to buy the covered call back is at a price less than what you paid for it, and when the price is decreasing, because again, the sellers of those covered calls will be more willing to sell them at a cheaper price if the price of the underlying is decreasing. So again, you want to sell covered calls when the price of your underlying position is increasing, ideally rapidly. You want to buy back those covered calls when the price of your underlying is decreasing, and again, ideally rapidly. Something like this large red bar on stocks, if you could get the buy back the covered call at a cheaper price on that highly volatile red candle, that may be a great opportunity. So again, that way you can continuously make money selling and buying back these covered calls, and again sell on big green candles, try to buy back on big red candles. So hopefully that helps you decide when is the best time to try to sell and buy back your covered calls. Okay, then once we decided, okay, we want to go ahead and sell, it's a good time to sell. What kind of expiration date? How far out do we want to look to sell the covered call? And one of the considerations, particularly with commodities, is you want to know what the cycle time of that commodity or that stock is. So if we look at stocks, we can kind of see bottom to top. We can see the most recent bottom. It bottomed in January, and then it peaked in pretty much the end of January. So that was a 1 month cycle. Then we see a bottom in March 30, and now it's nearly April 30, and it's approaching the top. So what we're seeing in stocks is about a 1 month cycle time. So ideally, you want to sell either weekly or 1 month out options. Now, if we look at another one that cycles pretty regularly, if we look at gold, gold again is another commodity that has a pretty regular cycle. And anything that cycles is a good candidate to sell covered calls. So if we look kind of bottom to top on gold, we can see, okay, March of 20 was the bottom, August of 20 was the top. So there's about a 3 month cycle. We look at another one, March to June. So again, about a 3 month cycle. October to November, that's a shorter cycle, and then December to March again. So in gold, we're seeing about a 3 month cycle. So you could go out, 3 months for gold, 1, 2, or 3 months for gold. stocks, we would want to be looking at a 1 month, ideally a 1 month cycle. So that's one consideration, is what is the cycle time, because we're wanting to sell ideally just above the peak so it expires worthless, or to maximize our profit very near the peak of the cycle if we're swing trading. Again, if you're long-term investing and you're just selling covered calls on something that has a upper right corner trend, then the cycle time is less of a consideration, and we'll look at maximizing our profits based on what can we sell a covered call for. So I hope that helps. Okay, if again our strategy is to be able to sell covered calls and potentially buy them back and collect the profit, and potentially do this multiple times to again increase our profit, kind of generate a dividend for ourselves, then how do we pick an expiration date and a strike price, again based on what we just found out about the cycle time. So if we're looking at stocks, again we can look at the April calls. I'm in the desktop version of Webull, and again, the best place to sell and to be able to chart covered calls, and we have another video I'll put the link to in the description box below, how you can chart the covered calls to see their trend over time and what's sold recently. The best place to do that is the desktop version of Webull. So one of the considerations we want to look at is for the nearest term, is there adequate price where we can undercut the current ask price by at least 5 cents. They go in 5-cent increments, so we want to be able to undercut the ask price by at least 5 cents. We want to pick a strike price that is ideally above a resistance point, because ideally we want it to expire worthless, so we just collect the premium, and we want to be able to buy it back at a lower price. So we need to have some room between what we sell it at and what we can buy it back for. So again, we don't have any problems here. If we look at stocks, there's plenty of room. If the ask price are pretty high, we can easily undercut that by 5 cents, and we can buy it back. And we can also see there's some open interest there. So this would be an April 22 or April 29 weekly. We could try to sell that. That would be fine. Again, we could undercut the price. We could go up to 70, sell it for 120, and then maybe even buy it back for 60 or more. Or we could go out to May, and again, no problem there. We could go strike prices as high as 75 or 80. No problem undercutting the price. There's some open interest, not as much. So again, you want to pick something that has enough liquidity, enough open interest, and where the prices are ideal. Now, if we look at some others that also have other commodities have long cycles, this coal, this is natural gas. Natural gas, we can see, has cycles that go in potentially 6 months to a year. So here, it's May of 2014 to February 2016, so a 2-year cycle. December of 2018 to June of 2020. So again, a 1.5 to 2-year cycle. So that is no longer an issue. So we can just choose whatever month we want that looks attractive. We can see some of these are attractive. That one, the $50 there is a little questionable, because we could only go 5 cents below. We'd only have 10 cents to work with. So again, another consideration is if it's only 10 cents to work with, or there's no open interest, no liquidity in that, then we might want to go a farther month out, be able to get better prices. Again, we need to be able to undercut the price. We want to be able to buy it back cheaper, and we want some liquidity to be able to do so. So I hope that makes sense. I hope that all helps. Please put in the comments if that's not clear, if you want any further clarification, if you have any questions about any of this, about what's the issue with the double-edged sword of selling covered calls in a retirement account. what's the best time, what are the time cycle considerations, the pricing considerations, the expiration date considerations, and the strike price and bid and ask price considerations. So again, leave your comments, your questions, etc. in the comments to this video, in our Facebook group, in our Discord, etc. And we'll be happy to try to answer your questions as soon as we are able. We hope this all helps you, maximize your profit with using covered calls, when to use them, when not to use them, when to sell covered calls, when to try to buy them back. Again, to generate the maximum profit on all your trading. So again, we hope this all helps. Good luck and have a great day.
Right now, as of the filming of this video, Webull is offering 5 free stocks when you open and fund an account. Typically they offer 2 or more free stocks, but sometimes they have special promotions, so please check our link to Webull in the description box below. You can also find on the About page or the header of our YouTube channel, BeachBum Trading YouTube channel, and or in the link section at the bottom of the About page, and or in the link section under Trading Platforms on our home page, beachbumtrading.com, bum without the U. And again, if you use our affiliate link to Webull, you can currently get 5 free stocks when you open and fund an account, and you can see those stocks can be up to $3,000 upon funding your account. So we hope that all helps. The content of this video was produced by BeachBum Trading. We hope you will choose to also join us in the BeachBum Trading community and subscribe to our YouTube channel. Visit us at our homepage at beachbumtrading.com, the bum without the U. Similarly on Twitter, BeachBum Trading, bum without the U. On Facebook and in our BeachBum Trading Facebook group. Please follow us on Pinterest and on Instagram. All of the links to our social media sites will be included in the description box below, and we hope you will choose to subscribe to our BeachBum Trading YouTube channel and follow us on social media. Thank you. We also cordially want to invite you to our new BeachBum Trading Community Discord server, where we can have discussions on all topics related to trading, success in trading, investing, etc. You can see alerts when we make trades, changes to our watch lists, etc. So again, please join us in the new BeachBum Trading Community Discord server. You should be able to find a link in the description box below. You can also find a link in the social media category on our web page, beachbumtrading.com, without the bum without the U, and also in the link section on the About page of our YouTube channel, etc. So again, we look forward to seeing you in the BeachBum Trading Community Discord server soon. Wave and say hello. Thank you again for watching our video. We hope that you liked it. If so, please smash the like button, give us a thumbs up. If you're not already subscribed, please consider subscribing to our BeachBum Trading YouTube channel. Please share this video with your fellow traders and friends. And please give us your feedback and any recommendations for improvement in the comments section below. And let us know what else we can do to help you in your trading career. Thank you again, good luck, and have a great trading day. If you like this video, we hope you will choose to subscribe to our YouTube channel by clicking on the box in the upper left-hand corner. You can watch another video like this by clicking on the box in the lower right-hand corner. And we have a whole playlist of videos like this that you can access via the box in the upper right-hand corner. Our latest video is available in the box in the lower left-hand corner. We hope you like this and have a great day.